liquidity ratio is problem 5. Guava Inc. provides the following data. The information is presented in a table broken down by 20x9 and 20x8. Cash 20x9, $24,000. Cash 20x8, $25,000. Accounts receivable net 20x9, $31,000. Accounts receivable net 20x8, $37,000. Merchandise inventory 20x9, $53,000. Merchandise inventory 20x8, $30,000. Property, plant, and equipment net 20x9, $128,000. Property, plant, and equipment net 20x8, $90,000. Total assets 20x9, $236,000. Total assets 20x8, $182,000. For the year ending December 31st, 20x9, net credit sales are $250,000, cost of goods sold $140,000, and gross profit of $110,000. Calculate the days sales and inventory for 20x9. We're looking at the days sales and inventory, and this is an inventory-related liquidity analysis. Now, liquidity analysis, we're focusing on current assets, current liabilities, and there's different categories. There's the current analysis, there's the accounts receivable analysis, and the inventory. Of course, days sales and inventory is an inventory analysis. Now, inventory analysis, all about a company's ability to manage its inventory effectively. And there are two different calculations, two main calculations we do when it comes to inventory analysis. Inventory turnover and the number of days sales and inventory. We're focusing on the latter, number of days sales and inventory, which is the more important in my opinion. Now, when it comes to inventory, companies want to try to get their inventory out as quickly as possible. They want to sell that inventory. And the reasons why decreases by not getting it out as fast as possible, it decreases liquidity by tying up funds, cash, and inventory. It increases insurance expenses, property taxes, storage costs, and other related expenses. And it increases the risk of loss because of price declines or obsolescence of inventory or spoilage or other types of things by storing it and keeping it around. So the idea is that we want to try to get the inventory out as quickly as possible. Now, the number or the days sales and inventory, that formula, we're actually going to end up needing the other formula I mentioned earlier for the inventory calculation. We're going to need to take 365 over, so the formula for days sales and inventory, 365 over the inventory turnover ratio. And I did the inventory turnover ratio in another problem. We're going to do it again here. So the inventory turnover ratio. And that formula for the inventory turnover ratio, that is going to be cost of goods sold over average merchandise inventory. Average merchandise inventory. We take the average because remember, cost of goods sold is on the income statement. And the idea is it's a period of time you're looking at an income statement. But merchandise inventory is on a balance sheet, which is a snapshot on a specific date. So you've got to take an average of the inventory over the time you're looking at cost of goods sold. So if you're looking at a year, which is very common, or a quarter, or a week, whatever it is, you got to take an average of that so you can keep apples to apples, not apples to oranges. So that's all we're doing here. We're going through calculating these things. We got to start by doing the cost of goods sold over the average merchandise inventory. Let's start with that. So cost of goods sold over average merchandise inventory. Let's extend our line there. So cost of goods sold over average merchandise inventory. We got to calculate that first. We're asked about 20x9, and in the past problems, we've eliminated 20x8, but we're actually going to need that for the average merchandise inventory, and I'll show you why. It might not make sense at first, but I'll explain why. So we have our cost of goods sold. We're looking at 20x9. We're told for 20x9, our cost of goods sold is $140,000. Let's go ahead and calculate that. So $140,000. So this equals $140,000. Now, the denominator is the average merchandise inventory. We've got merchandise inventory here, 20x9 and 20x8. We have to do the average of these two to show the change, as I mentioned earlier. Now, why? Why are we doing this? Think about this. This is a balance sheet. And if we're looking for the year ending December 31st, 20x9 for the income statement, that is for the entire year, for all of 20x9, because we're asked about 20x9. So you're like, okay, well, why are we looking at 20x8? These are December 31st. These are December 31st, 20x9, December 31st, 20x8. So on January 1st, 20x8, this will be the same, on January 1st, 20x9, December 31st, 20x8 will roll over because they're permanent accounts. Oh, yes. So this is the same as 1/1x9, and this is 12/31x9. X9. So to get the change in the year, we're going to take the average of 53,000 and 30,000. So we're going to add those two numbers together, 53,000 plus 30,000, and we're going to divide that by 2. And when you do that calculation, 140,000 over the average of 53,000 plus 30,000, you're going to get 3.37. So the ratio is 3.37, or it turns 3.37 times, which is not bad, but also not too good. It's somewhere, again, it really depends on the industry. We saw a problem earlier where they were turning it in 20 times. That's really good. So the idea here is you have 140,000 cost of goods sold, and you have somewhere in the $41,000 range of average merchandise inventory. Yeah, you're covering enough, but you could be a lot better. That is the idea. You're covering enough, and again, it's all about it could be a function of the industry, and it depends on that, or the year, all those different types of things. The idea here is we now have our inventory turnover ratio. We now can determine the days sales and inventory. We use this formula right here, 365 over the inventory turnover ratio. We're going to take that number, 365, because remember, this is a day, so we use 365 days. Divide that by 3.37. When you calculate that, you're going to get 108.31 days. So what this is saying, this is the number of days sales and inventory. It's a rough estimate of the length of time it takes to purchase, sell, and replace the inventory. So it's taking on average 108 days to go through the process of purchasing, selling, and replacing the inventory. 108 days. So again, depending on the industry you're in, this could be bad, could be good. Depends on, again, what you're going on with the type of business. It could be a bad amount. It's somewhere, I think, in the okay area, just in taking a general stab at things. But the idea is that if you're in a food retailer, you would want to be turning over things much faster because that food could be going bad, or prices could be changing, things like that. So you have to keep that in mind. But if it's something that inventory just doesn't sell that quickly, like if you are building boats that you sell as inventory and it takes a few months to sell them, or cars or whatever it is, this could be not so bad because it's less than 4 months. It's not too bad. So it really depends on what industry you're in. 108.31 days is how long it's taking to purchase, sell, and replace the inventory. Again, have to go into determining the first the inventory turnover ratio and getting that number, and then calculating the number of days sales and inventory.